Picture yourself just after your 60th birthday, finally feeling like your super is yours to use. You've probably heard that at 60, it all goes tax-free. And if you've believed that, honestly, that's not a mistake on your part, because almost nobody explains the fine print. Here's the truth. Your lump sums can often come out tax-free, but if your money is still sitting in what's called accumulation phase, your fund can keep taxing the earnings at 15%, quietly every year until you move it across. Let me show you exactly how to stop that. Here's the number I want you to remember: 15%. According to the ATO and Industry Super, that's the tax applied to your super's investment earnings while your money stays in accumulation phase. And it keeps applying even after you turn 60. But here's the part most people miss. Once that same money supports a retirement income stream, those earnings are generally taxed at zero. That gap between 15 and 0 is the whole reason this matters for you. And it's exactly what we're going to close. Let's make this real with your own numbers. If you're on the conservative end, say $250,000 still in accumulation earning 6%, that's $15,000 in earnings and roughly $2,200 lost to tax each year. In the middle, with $500,000, the ATO and industry super figures show about $30,000 in earnings and around $4,500 lost annually. And if you've got closer to $800,000, you're looking at over $7,000 a year gone before compounding even starts. In retirement phase, those same earnings would generally be tax-free. Your first practical move takes about 5 minutes. Sign into MyGov, open ATO online services, and go to your super and retirement details to confirm your age, your access condition, and your fund type. This tells you exactly which part of your balance can move from 15% taxed earnings across to 0% retirement phase earnings. It's the single most valuable thing you'll learn today. And here's where it gets genuinely interesting, because the next step decides how much actually comes out tax-free. Second, check your benefit type using the ATO's guidance on tax on super benefits. If you're 60 or older, your payments may be tax-free, but it depends on whether they come from a taxed or untaxed source and whether you take a lump sum or an income stream. Now, I want to be upfront with you here. This is where it gets fiddly, and it's the one part where a wrong assumption can quietly cost you for years. If you're mostly in a standard industry or retail fund, you're likely a tax source and it's straightforward. But if you've ever been in a government or public sector scheme, check carefully, because untaxed sources are treated differently. Third, where you qualify, move your eligible balance into a retirement income stream, so those earnings stop being taxed. The ATO notes that retirement phase benefits from a tax source are generally not assessable income once you're 60 plus, and earnings in this phase are tax-free up to your transfer balance cap. This is the step that actually turns your 15% into 0. And it's usually a form your fund can help you complete. This is where most people leave the biggest money on the table, so stay with me. Finally, before you leave a big balance parked anywhere, compare your fund using the government's Your Super comparison tool. Check your fund's fees and net returns against the benchmark options side by side. There's no point winning back tax savings after 60 of high fees quietly erode the same money on the other side. So make sure the structure you choose is competitive as well as tax smart. That's your 5 steps done. Now let me show you what this looks like for a real person. Meet Mark, a 62-year-old electrician with $620,000 in super. If you're in a similar spot, this'll feel familiar. Industry Super and the ATO show that if he keeps it in accumulation, earning 6%, his earnings are about $37,200 a year, and roughly $5,580 of that gets taxed at 15%. That's money he could simply keep just by moving eligible funds to retirement phase when he qualifies. Nothing about that requires him to earn a cent more. Now stretch Mark's situation out over time. Over a 5-year pre-retirement window, That drag adds up to about $27,900 in avoidable tax, according to Industry Super and the ATO, assuming the balance and return hold steady. And that's before compounding, which only widens the gap. Think about what an extra $28,000 means in your retirement. That's real income you get to keep, purely from understanding your structure early enough to act. The most common mistake I see is assuming that once you turn 60, all your super and its earnings are automatically tax-free. The ATO is clear that tax treatment actually depends on your age, the payment type, and whether your super comes from a taxed or untaxed source. Your accumulation earnings can still be taxed at 15% even when you're over 60, so age alone doesn't unlock the tax break. If you've been quietly assuming otherwise, you're in very good company, and now you know exactly what to check. The second mistake is one of the easiest to make. You qualify to move money into a pension, but you simply never get around to it. The ATO and Industry Super show that leaving a balance sitting in an eligible structure without converting keeps that yearly tax drag running year after year. One thing to keep in mind: the transfer balance cap, introduced in 2017, limits how much you can hold in retirement phase, so check the current cap before you act, rather than assuming your whole balance qualifies. So let's run it back quickly, so you know exactly what to do. Understand that your accumulation earnings are taxed at 15%. Check your access status in MyGov. Confirm whether your benefit is taxed or untaxed using the ATO. Move eligible money into a retirement income stream where you qualify. And compare your fund with the Your Super tool so fees don't undo the saving you just made. 5 steps, and most of them take minutes, not weeks. If you've made it this far, you now understand something most people over 60 simply don't: that the 15% tax gap is fixable and it's yours to close. The one thing to do today is sign into MyGov and check your access status, because everything else flows from there. If you want to go deeper, next up I'm walking through exactly how the transfer balance cap works and how much you can actually hold tax-free in retirement phase. I'm Alex, I'll see you there. This video contains general financial information only and is not financial advice. Superannuation rules and thresholds change regularly. Always check with a licensed financial advisor or the ATO before making decisions.